Hi, in this video, I'm going to give you some great trading tips about using stop losses, both dollar-based and average true range based. And stick around, and in the latter part of the video, I'll tell you a great way to get the best of both of those stops. I'm champion trader Kevin Davey, and let's get started. Okay, so we're going to talk trading tips. What kind of stop losses should you use? Should you use dollar-based or volatility-based, which is really average true range? Well, back when I was starting out trading, that was one of the many questions I had. And everybody said, use average true range. Why did they say that? Well, it was just one of those market truths that you just say, oh, okay, I guess I have to use average true range for my stops. But it always kind of bothered me. I didn't really understand it and why it was the best thing to use. So, after a few years of using it, I actually started to use dollar stops. Why? Well, conventional wisdom is to use a 3 times average true range stop. Okay, but the problem is when you look at that, sometimes that gets to be a really big number when you look at it in dollars. So a 3 times average true range is sometimes a huge stop loss, and I never liked that. And then other times it was a small stop loss because the volatility was low and you'd be stuck getting $250 stop losses all the time, and the market would go back and forth and eventually just take you out. So that wasn't real good either all the time. So I started looking at dollar stops. So I would take $1,000 or $2,000, and that would be my stop loss for my entry. And the funny thing is, it improved my performance. My performance got better when I started to use that. So for years, I was using dollar-based stop loss. I thought I was just crazy and it was just working for me, and I was afraid really to tell anybody about it. It's kind of an abnormal thing when you look at what most people say. Use average true range. And then one time I was in New York and I was visiting my friend and fellow champion trader Andrea Unger, and I decided to ask him. And I told him about my dollar stops and said, what do you do? Have you ever done this? And I was shocked because he said, yeah, I do that. And it works for me a lot of the time. Average true range is way overhyped. So then I knew I was onto something. Okay, so let's do a battle of exits. Dollar stops versus average true range stops. I'm going to look at 3 different markets: crude oil, gold, and mini S&P. Those are pretty popular markets. I'm going to use daily bars. These are futures that I'm trading, and I'm going to look at 4 different strategies. Strategy 1 is just a momentum-based strategy, pretty simple. Strategy 2 is an RSI strategy, also pretty simple. Strategy 3 actually is a counter trend strategy, so you have a long-term trend and you go against that in the direction of a shorter term trend. And strategy 4 is based on Bollinger Bands. So we're going to take each one of those strategies and we're going to work with different stops. So for a dollar stop, I'm just going to pick 3 values. That's a pretty big range, and it's a pretty decent range. Now, a lot of you might be thinking, wow, I like $100 stops. Well, the problem is with the $100 stops, you usually get stopped out a whole lot. I mean, a lot of people like them, but the reality is you get a lot of stop outs with those. Where if you have a bigger one, you let the market move a little bit and give it some breathing room, and that turns out to be a lot better usually. So we're going to use $1,000 to $2,500 stop loss in dollars. And then for average true range, we're going to use 1, 2, or 3 times the average true range, and that's what we'll use. And then we're going to judge performance. Normally, When I judge performance, what I do is I look at the return to drawdown ratio that I calculate with my Monte Carlo spreadsheet. But in this case, we're going to keep it a little simpler and we're going to use profit factor. As it turns out, profit factor is pretty close to return to drawdown. They're pretty well correlated. So it's a quick and easier test to run so that we can see what's better, stops in dollars or stops with ATR. Okay, so first I run just a baseline case. Let's see where we're at with no stops, just the exits that the strategy does. And as you can see, sometimes it's good, sometimes it's not so good. So we've got a wide range of profit factors, which is good for this study. We don't have all optimized data or anything like that. We have pretty realistic results that we can look at. So after we do the baseline test, then I'm going to run stops with dollars and stops with ATRs. And here's the results for the 4 strategies. What you'll see when you look at this is a lot of the time, either a dollar stop or an ATR stop is better than no stop. Sometimes it's not. And in more cases, the ATR stop is actually a little bit better than the dollar stop. Kind of interesting. So the results, a lot of times not having any kind of stop has better performance than having either a dollar stop or an ATR stop. And ATR stops are usually better than dollar stops, but not all the time. So how can you use this data? Well, first of all, you should not believe all the market adages you hear, because you've probably heard, don't use dollar stops. Well, this study says dollar stops can be decent and sometimes they're even better than ATR stops. So throw that adage out the window. The other important thing is that you should test what you're doing. If you want to know which one's better, you test it, and then you rely on those results. So ATRs are a little bit better a lot of the times, but I don't really like them because sometimes you get huge stop values. So is there a way you can combine dollar stops and ATR stops? Well, sure. Here's a way to do it, and this gets the best of both worlds. It's called the floor and ceiling approach. You can actually use it as a floor, a ceiling, or both a floor and ceiling. So the way it works is you use an ATR stop, but then you either put a floor in at a certain dollar amount or a ceiling in at a maximum dollar amount, or both. So for example, you have a 2 ATR stop with a minimum stop of $1,000 and a maximum stop of $2,500. That way, you have a min and max that you know in dollar terms, so you don't have to wonder what the volatility is doing to your stops. And in the middle, you have an average true range stop, which moves with volatility. So it's kind of neat because it has the best of both worlds. So let's take a look and see how that performs. So you can see from the results of these 4 strategies that many times this new kind of stop is better than just a dollar stop or just an ATR stop. The problem is it's not that much better. It's a little bit better, but they're not dramatic results. I was hoping to see some dramatic results. And the fact I don't kind of tells me this really isn't that great as a performance enhancer. But remember that this combination stop is really nice psychologically, because now you know either your floor stop or your ceiling stop, and then you can let the middle go with volatility. So it's kind of a neat thing to have. It just doesn't help out performance that much. So what have we learned with this kind of stop? Well, again, the key is you have an idea, you test it. You don't just think, well, hey, I really like it, so I'm just going to use it in the hopes that it's going to perform better, because sometimes it doesn't. So I thought this was a really neat way to combine dollar stops and ATR stops, and it is. It just doesn't improve your performance that much. So, oh well, psychologically it's still a really cool thing to use. And again, the other thing we found is that dollar stops are a viable alternative to ATR stops. So you don't need to just use ATR stops. You can use dollar stops and probably perform pretty well. Heck, that's what I've been using most of the time when I've been trading. I have systems with dollar stops and I have other systems with ATR stops. I use them both, and you probably should too. And whatever works best is what tests the best. Well, I hope you enjoyed this video. I hope you've learned a lot. Down below, you'll see a link to get resources for code and workspaces so you can develop this on your own. You can expand the research, you can see what I did, and you can take it to a whole nother level. So if you really like this video, please subscribe to my channel, give it a thumbs up, like, and if you agree or disagree with what I found, leave a comment. Let me know. Let me know what your research says. I'd be interested to know. I'm Davey. Thanks for watching.